G'day traders, 1 minute mindset reset today, talking about scalpable versus scalable trade setups. So I got a great question from a trader asking me about how much size I trade on trades, and I go back and pointed him or her into that direction of the risk management video, explaining that every setup has different criteria in terms of what makes it a 3-star, a 5-star, or a 1-star, whether it's just a scalp, whether it's a scalable trade setup. There's different setups within the sessions that are scalable, and then there are larger scalable setups that are, high of day, low of day, 3 levels, 3 weeks, 3-day setups, those sorts of scenarios where you're looking at 100 or more pips potential in a vertical trade setup. Now there are scalable session trades that are 50, 25 to 50 or more, depending on the instrument that you're going to identify that in, that are scalable because of the coil and the compression, the consolidation that's built up for an explosive move. There are other trades that are session scalps that may be 25 to 50 pip trades, but the way that they set up and the way that they'll probably play out, they're not necessarily 5-star scalable setups. They're scalpable though. They're scalpable. There's a high probability, high conviction for the trade. But in terms of it moving vertical, it's a different style of trade setup. So I gauge that for myself based on my conviction of the explosive move. So if it's going to be an explosive move and I've got consolidation, 2 to 3 hours of consolidation, or if it's a stop hunt reversal, there's different scenarios, but 3 sessions rise, 75 to 100 pips or more with space, high day, low day, news catalyst, those sorts of things that have the potential to continue for an extended period of time. So for example, a move in Asia probably won't continue all day long, but a move that occurs in the New York session has the potential to go maybe right into the close of the session, a Friday night trade, stay a unidirectional market for the rest of the entire move, or at least 3 levels being, if it's NASDAQ, S&P, gold, it could be a 300 pip box, 3 levels of 100. So every trade setup is gauged based on the time of day, how it unfolds in the template over 3 sessions. It might be a London, New York, Asia trade. It doesn't always have to be Asia, London, New York. It could be a New York, Asia, London trade, high of the day, high of the week, low of the day, low of the week scenario. So these are all important to understand when you're identifying your best trade setup. So not everybody's going to resonate the same with me. I got a question about, can I talk about other time frames? I think there's a big misunderstanding still that time frame, when you have a level that you're going to get in at based on the time of day and the setup, the time frame is not relevant to me. So for example, if I know that I'm going to go long, I had a trade on Asia this morning on the yen. I know that I'm going long. There was a pre-market entry, and then there was a first bar entry right when the session started. Now Asia is a little bit different than the other 2 sessions for me in terms of how I gauge London and the New York equity market opens. There are trades that I look for in the rollover and based on how the US session closes. So when that market presents that opportunity, and I'm in that trade, I'm looking at the level. I want to get filled at a price level. So people have asked me, how do you come up with the 100 pip box? It's the price. I don't come up with anything. It's the price. Double zeros, 50s, and quarter levels. If you're not sure what that is on the instrument that you're trading, it should break down into quarter. You could do 250 pip boxes if you wanted to trade on larger increments. It doesn't matter. But it's the price. I'm not making anything up. The price is the price is the price, and the time of day is the time of day, the time of day. The high and the low are the high and the low. I don't make any of that stuff up. So it is what it is. And it shows up every single day. The point I'm trying to emphasize is that if I'm getting in based on a trade setup and a thesis, I'm going short, I'm going long, the high of the day might be in an upper 25 pip box. I want to get filled above that quarter level. That means if I've got 3 levels of rise and there's 75 pip box, that upper quarter is the trap volume. Somebody asked me, oh, you only just work on peak formations and volume. I'm not working on volume. I'm talking about trapped traders in the upper quarter, and there's space 50 pips below, 25 to 50 pip space that the market can free fall in. And that's putting pain into traders that are caught up high long, or if they're caught down short on their lower level shorts. That means if they get stopped out, or they average into a loser, or their stop loss widens, their loss increases, the market's going to bend their arm, maybe margin them out. So you're looking for your best scalable trade setups. And those are the ones I like to see come out of consolidation. My scalable trade setups are the ones that will come out of consolidations. That becomes squeezes. The scalpable ones typically will be high and low opportunities that are just going to go 25 to 50 pips, and they tend to be counter trend trades. So they're not always going to be scalable, but if it locks in the high or the low, a squeeze setup can come out of those reversals, and that's when you can I look for scalable second leg entries into those peak formation reversals. So hopefully you got value from today's video, traders. Scalable versus scalpable trade setups. We've already had some big moves. It was Memorial Day yesterday, and the market still gave some great trade setups. It's going to be a great week. Keep it simple, focused on your highest probability opportunities, stick to the time frames, manage your downside, lock in profits, get off the screen, and have a great week.